All right, today I want to talk about what may become the next major transition in the AI industry. For the past couple of years, the AI boom has mostly been about one thing: GPUs. Whoever could get NVIDIA's GPUs online the fastest, whoever could monetize those GPUs the fastest, won. That's one reason why CoreWeave and Nebius increased in value over the last few years. Wall Street rewarded rapid deployment, contracted capacity, backlog growth, and explosive AI revenue. But what if the next bottleneck is no longer GPUs? What if the next phase of AI becomes about power, cooling, campuses, electricity, and physical infrastructure itself? Because AI may be evolving from a GPU race and into an infrastructure race. And if that happens, the entire valuation framework around AI compute companies could eventually change. So today we're going to break down why Wall Street currently rewards GPU monetization, why infrastructure constraints may become increasingly important, why electricity itself may become a strategic asset, why companies like IREN may be taking a different approach, and why the next generation of AI winners may not simply own GPUs. They may own the infrastructure powering the economy of AI. And before we talk about where AI is going, we first need to understand how the market currently values AI compute companies. Right now, Wall Street mostly rewards one thing, which is speed, specifically how quickly companies can bring NVIDIA GPUs compute online and monetize it. And that's where companies like CoreWeave and Nebius compute online and monetize it as they become incredibly important.
Nebius is one of the world's largest AI infrastructure businesses. We're building data centers, GPU clusters, and effectively AI cloud around the world to service AI native customers, enterprise customers, basically any company that's deploying AI workloads. Nebius leverages a distributed AI infrastructure using Equinix as a cloud on-ramp to enable customers to connect to our platform in order to build one of the world's largest commercially available AI infrastructure businesses. This empowers our mission to meet fast-growing demand for high-quality infrastructure from builders around the world.
Nebius and CoreWeave are helping what investors now call the neo cloud industry, which simply put, neo cloud companies are next generation AI cloud providers focused on renting high performance NVIDIA GPU compute to customers. First phase of the AI boom was essentially get GPUs online as fast as possible. Here's a video explaining CoreWeave's philosophy.
CoreWeave's AI native cloud platform is purpose built to power the world's most demanding AI workloads at scale. With a global footprint of over 40 data centers, we provide full stack services for leading AI labs and enterprises. Our data centers are interconnected with a high speed terrestrial and subsea fiber optic network for massive bandwidth at ultra low latency. From final fit out to fully provisioned capacity, we accelerate delivery to weeks versus months, enabling our customers to significantly accelerate time to production. We engineer our data centers with the latest NVIDIA GPUs, next-gen NVIDIA networking, power, cooling, and observability, all with layers of backup power for continuous uptime, so your training and inference workloads run uninterrupted. Beyond traditional air cooling, we deploy closed-loop direct-to-chip liquid cooling. This ensures optimal GPU performance while minimizing water usage and reducing data center power consumption by over 10%.
The market loved this model because it created explosive revenue growth, visible backlog, hyperscaler relationships, and financial scalability. The thesis was straightforward: AI demand is exploding, GPU supply is scarce. Whoever monetizes GPUs the fastest is going to win. And honestly, that framework made a lot of sense because during the first phase of the AI boom, GPU scarcity was a dominant bottleneck. But now the industry may be approaching a turning point because GPUs alone may no longer be enough. And this is where things start to become very interesting, as the next bottleneck may increasingly shift towards electricity, cooling, substations, transformers, campuses, and energized infrastructure. Here's the CEO of IREN, Daniel Roberts, talking about that as well as IREN's philosophy.
Let's bring in now Dan Roberts, co-founder and co-CEO of IREN. Dan, first of all, give us a brief history of the business and how you got from where you were just a couple of years ago to this point.
Yeah, thanks, Charles. Look, it started with a really simple observation that the world is going to need an enormous amount of compute infrastructure, and the physical ability to deliver that compute infrastructure was going to be constrained. Access to land, power, cooling, construction. So for the last 8 years, we've been assembling the inputs. We've got 5 gigawatts of secured powered land. We're active in 3 continents, and we're delivering to some of the biggest customers.
We're going to bring the other first chart back up, this first table back up to talk about just how critical it is, because it is a key part now of the value chain. It has to be done. You've got some pretty well-known competitors, Nebius, IREN, CoreWeave, and of course, you got now Google. Looks like Google, Blackstone. What do you make of these large firms? You got the largest private equity, one of the largest hyperscalers. Does that intimidate you, or does that really validate what you've been trying to say all along?
It's exciting. It's fantastic. For 8 years, we've been waiting for this moment, and to have that validation. The private equity parties, they need operating partners. The hyperscalers, they can't deliver it at all. We've already signed a $10 billion contract with Microsoft.
Now, this does not mean power never mattered before. Power always mattered. But as AI clusters become larger, denser, and dramatically more power hungry, the physical infrastructure challenge becomes much harder. Early AI demand could often be satisfied by retrofitting existing data centers, leasing capacity, and rapidly deploying GPU clusters. But future AI scaling may require purpose-built AI infrastructure, and that's a completely different challenge. One of the biggest misunderstandings investors make right now is confusing contracted power, approved power, energized power, and fully operational AI compute. Those are not the same thing. Just because GPUs arrive does not mean the compute can immediately go online. Just because power is contracted does not mean the infrastructure is fully energized and operational. Building substations, cooling systems, high voltage distribution, and integrated AI campuses takes enormous time and a ton of capital. And that may become one of the defining bottlenecks of the next AI era, because the market can manufacture more GPUs over time, but it cannot rapidly manufacture years of infrastructure development overnight. And this may lead to something much larger: the rise of the AI factory. The first phase of AI was like rushing to buy the best engines. The next phase may be about building the entire factory around those engines, because future AI systems may depend on entire ecosystems working together: power delivery, cooling, networking, orchestration, uptime, and infrastructure integration. This is where the thesis becomes a much bigger picture than GPUs alone. The moat may increasingly become the infrastructure itself. And that's important because integrated AI factories are extremely difficult to build. They require massive capital, years of infrastructure planning, grid access, cooling systems, and operational reliability at an enormous scale. This is no longer just cloud computing. This is increasingly resembles industrial infrastructure. And NVIDIA itself appears to be moving further toward integrated AI systems and full stack AI infrastructure. And that could become a major clue about where the industry is going. Access to electricity is becoming extremely valuable because AI data centers consume enormous amounts of power. As hyperscalers continue scaling AI infrastructure globally, electricity demand may rise dramatically over the next decade, and that changes the competitive landscape. In the first phase, GPUs were scarce. In the next phase, electricity itself may become scarce. And that's a huge shift. And this is where companies like IREN become very interesting. IREN has already secured access to massive amounts of electricity and energized infrastructure.
Welcome to West Texas, where the future of AI infrastructure is being built. Behind me is the site of Horizon One, our direct-to-chip, liquid-cooled AI data center, designed to support up to 50 megawatts of IT load and rack densities reaching 200 kW per rack. This data center project represents the future of infrastructure for AI, not just for IREN, but for the industry as a whole. Horizon One is more than just a name. It's a vision, a reflection of our forward-looking mindset, our commitment to disciplined execution, and our drive to build smarter, more sustainable, and more powerful operations. At IREN, every substation, every data center, every hardware deployment has taught us something. And Horizon One is the result of that experience, scaled up, accelerated, and sharpened by everything we've learned. Projects like this don't come together by chance. They require precision, planning, and a team that understands both the big picture and the smallest detail.
And that matters because not all power is equal. There's a massive difference between theoretical future power, contracted power, and already energized operational infrastructure. And if AI demand continues accelerating, whoever controls large scale electricity access may eventually gain enormous strategic advantage. But the market may eventually realize that GPUs alone are not the moat. Access to power, cooling, campuses, and operational infrastructure may become equally important, or potentially even more important over time. Now, this does not mean that companies like CoreWeave or Nebius suddenly fail. That's not the point. The point is that the industry itself may evolve because right now the market mostly rewards rapid GPU monetization, but IREN may be optimizing for something different, long-term AI infrastructure control. And this is where capital intensity becomes very important. Building AI factories is extremely capital intensive. And simply put, capital intensive means these companies require enormous amounts of money before meaningful profits arrive. We're talking about data centers, substations, cooling systems, transformers, networking, GPUs, land, and high voltage infrastructure. Billions of dollars of infrastructure investment. And that's why this becomes such a massive strategic bet. And if the next phase of AI becomes infrastructure driven, then capital intensity itself may become part of the moat because not every company can realistically spend billions of building energized AI campuses at scale. IREN appears to be making a large bet that integrated AI infrastructure becomes increasingly valuable over time. And that's a very different strategy from simply maximizing near term GPU monetization. And the company's relationships with Microsoft, Dell, NVIDIA, and its AI factory deployment strategy may become increasingly important if this infrastructure thesis plays out. Now, here's the big question. What happens if Wall Street eventually starts valuing AI infrastructure differently? Because today's valuation framework mostly rewards monetization speed, backlog growth, and rapid revenue scaling. But future valuation frameworks may increasingly reward power access, cooling, uptime, operational infrastructure, and integrated AI campuses. And valuation frameworks can completely change when industries mature. This does not mean CoreWeave or Nebius disappear. They may continue winning for years, but the rules of competition themselves may evolve. And if AI increasingly becomes physical infrastructure, then future winners may look different from today's winners. Now, of course, this entire thesis remains speculative. The GPU-centric model could absolutely continue dominating for years. NVIDIA demand could continue exploding higher. Markets may continue rewarding rapid monetization and backlog growth. And infrastructure-first strategies carry enormous risk too. Execution matters, timing matters, power deployment matters, cooling systems matter, construction timelines matter. Building integrated AI factories at massive scale is extremely difficult, so this is not a guaranteed outcome. But if the AI industry truly transitions towards infrastructure heavy compute, then the competitive landscape may eventually change dramatically. The AI boom may be entering its next major phase. The first phase was about GPUs. The next phase may increasingly become about infrastructure. And the next generation of AI winners may not simply own chips. They may own power, campuses, cooling systems, and operational infrastructure required to run AI at massive scale. That's why the entire debate matters so much, because AI is no longer just software. It's becoming industrial infrastructure. So today on May 21st, 2026, IREN is at $56.81. Price to earning ratio is high at 126.95. Nebius is at $225.62. Price to earning ratio is at $81.45. And CoreWeave is at $107.97. And the price to earnings ratio is, it was there before, I don't see it. You can see the earnings per share is at minus $3.26. Nebius earnings per share is at $2.73. And IREN's earnings per share is at 44 cents. IREN declined over the past month as massive capital raises offset operational milestones. Analysts project continued volatility through a landmark NVIDIA partnership and successful Texas facility energizations serve as strong catalysts. Sentiment suggests long-term upside as the company transitions from Bitcoin mining to a high-margin AI cloud infrastructure provider. The bullish is landmark NVIDIA strategic partnership as IREN has secured 5-year, $3.4 billion strategic partnership with NVIDIA to accelerate deployment of up to 5 gigawatts of AI infrastructure. This deal validates the company's transition into AI cloud space and supports a projected expansion of $3.7 billion in annual recurring revenue by the end of 2026. The bearish is heavy shareholder dilution risks, as IREN recently closed an upside $3 billion convertible note offering and filed at $6 billion at the market equity program. While these funds support massive capital expenditures, the scale of these raises potential conversion into equity pose significant dilution risks for existing shareholders. For Nebius, quarter 1 2026 surged significantly following earnings report with a major $2.6 billion fuel cell agreement with Bloom Energy. Analysts project continued upward momentum through the next quarter as companies scales its AI cloud infrastructure and converts massive contract pipelines into realized revenue. The bullish is explosive revenue growth and profit turnaround. Nebius reported massive almost 700% year-over-year revenue surge to $400 million in first quarter 2026, driven by its AI cloud platform. The company achieved a remarkable turnaround in profitability, swinging from a net loss to a profit of over $620 million, significantly exceeding market consensus for the quarter. And the bearish is high valuation and financial strain risks. Despite rapid growth, Nebius trades at a high price per earnings ratio exceeding 56x. Some analysts' caution reflects extreme optimism. The company also raised its 2026 capital expenditure guidance to approximately 20 to 25 billion, which may pressure near-term cash flows and lead to volatile margin performance. Now, CoreWeave. CoreWeave declined significantly over the past month following Q1 earnings miss and concerns over rising debt load. Catalysts include a record $100 billion revenue backlog and major capital raises from NVIDIA and lenders. Market consensus suggests that while long-term AI infrastructure demand remains high, near-term volatility will persist as the company scales. Massive revenue backlog demand in CoreWeave ended Q1 2026 with an unprecedented revenue backlog of approximately $100 billion, 284% year-over-year increase. Analysts point to strong revenue visibility through 2027, anchored by long-term agreements with major players like Meta Platforms and OpenAI, which provide a foundation for projected 100% revenue annual growth. The bearish is heavy debt loads and interest costs. Total liabilities have surged to over $50 billion against approximately $4.7 billion in shareholder equity. With quarterly interest payments estimated at $310 million, analysts warn that any slowdown in the AI market expansion could place severe stress on CoreWeave's highly levered financial structure. So if you enjoyed this video, make sure to like and subscribe. And if you want the visuals from today's video, they're going to be located at buymeacoffee.com membership community, as well as AI infrastructure research, other visuals from other videos, and portfolio updates. So thanks for watching, and we'll see you in the next one.